Hello, I'm Aurora Davidson, CEO of Amerigo Resources. I'm doing a series of videos to show you why our stock should be part of every copper growth portfolio. In the previous video, I explained why Amerigo's growth, which is growth in your personal return on invested capital, outperforms the traditional production growth scenario. In a production growth scenario, future earnings are expected to grow, and as new production approaches, investors will pay more for those anticipated extra earnings. Production growth stocks are a story about the future, with the bulk of investment gains coming in the future, the riskiest place of all. Risks can be as simple as management's ability to complete projects on time and budget, or as wide as the market sentiment when you decide to sell your shares to realize gains. You should contrast that with Amerigo's growth, which is a story of the present. The majority of uncertainties are behind us. We are now in a profitable final production stage, and the return on invested capital for Amerigo shareholders has shown significant and consistent growth. Amerigo's type of growth is tied to copper prices, and as copper prices continue to strengthen, we expect the growth of your return on invested capital to accelerate as well. You have already seen this with the payment of our first performance dividend. If you haven't already, I encourage you to visit our website and download the spreadsheet I mentioned in the previous video. It provides a clear picture of the attractiveness of Amerigo's current return on invested capital growth. The spreadsheet is a hypothetical 10-year forward look at Amerigo. It is not our official guidance, but it is a simple, user-friendly tool so that you can develop your investment scenario. To reduce the spreadsheet's complexity, we made some simplifying assumptions. For example, Amerigo's production and operating costs are assumed to be stable. We also assume that extra cash will be paid out in dividends, not as a combination of dividends and share buybacks, which of course may not be the reality over the next 10 years. It is just a simplifying presentation assumption. As shown on the spreadsheet, you can work with a range of free cash flow to equity numbers. And these numbers are based on our 2024 guidance, and they are accurate up to $4.80 per pound of copper. You can load different Canadian to US dollar foreign exchange rates, and you can also change Amerigo's share price to reflect your preferred purchase price. The spreadsheet will then show you the potential annual dividends and calculate a yearly return on invested capital based on those dividends. You can also see the cumulative return on invested capital, which is tremendous at $4.50 copper, for example. Now, let me show you two additional parts of the spreadsheet. The first is the return on invested capital with dividend reinvestment. This line assumes you can reinvest your Amerigo dividends at the constant share price in the spreadsheet without tax implications. Yes, I know those are simplifying assumptions, but they illustrate that tremendous positive impact of dividend reinvestment. In our hypothetical 10-year buy and hold strategy, the difference in cumulative return on invested capital with reinvestment becomes significant with time. In this case, using a hypothetical base case of $4.50 copper prices, the compounding effect becomes quite noticeable by year 3. By year 5, it is remarkable, and by year 10, you have over 80% more money in your pocket simply through reinvestment. Of course, the impact of the reinvestment is so large because of the significant dividends that Amerigo already pays. Where else can you find a copper equity investment with this growth feature? This kind of growth matters to you as an investor. It is growth in your personal return on invested capital. The second part of the spreadsheet I want to show you is the share price appreciation, which we are confident will come to Amerigo shareholders. Again, to simplify the spreadsheet, share price appreciation occurs at the end of the model in 10 years. Of course, in reality, it can happen at any time. As you know, I believe Amerigo shares are undervalued. You can tell this because our dividend yield is so high compared to other industrial stocks, such as those in the S&P 500. Given the predictability of our operations and the near certainty of firm and rising long-term copper prices, I think that our quarterly dividend, is as safe as dividends that are paid by multinational conglomerates. So why shouldn't we trade at the same dividend yield as the S&P 500? We have decades of copper available to process and near certainty of higher copper prices. But there's another way to assess whether Amerigo's shares are undervalued. That metric is the free cash flow yield. Other companies may generate free cash flow, as we do, but they choose not to distribute it to investors, or they can't. Of course, our capital return strategy does precisely the opposite. We return excess cash to shareholders as quickly as possible. However, if a company generates free cash flow, its free cash flow yield can be compared to other companies. It's a very simple calculation: free cash flow over market cap. The average free cash flow yield of S&P 500 stocks is about 6%. Amerigo is currently trading at almost a 12% free cash flow yield. That means our share price needs to double to align with the S&P 500. Our spreadsheet keeps the share price constant over the hypothetical 10-year holding period to keep things simple. But let's assume that when we reach the end of the model in 10 years, the market finally understands that it has mispriced Amerigo shares. What would happen? The spreadsheet shows Amerigo would have a free cash flow yield of almost 17% in 10 years. To align with the S&P 500, Amerigo shares would need to increase by over 175%. That share price appreciation is in addition to the tremendous cumulative dividend gains occurring regularly, yearly. Where else in the copper space can you find growth in your return on invested capital like this? Unless you're speculating in the copper sector, copper growth stocks can't provide the types of gains illustrated in our spreadsheet. They also can't do it with a level of certainty that Amerigo offers to investors. And that will be the topic of another spreadsheet that I'll share with you soon. You see, Amerigo is not about speculating on future growth. It's about receiving the benefits of the long-term rise in copper prices on your invested capital. I hope you enjoy the spreadsheet, and I'm happy to answer any questions you may have about it. Thank you.